Right, and we were talking about the capital asset pricing model, CAPM or CAPM in short, and we learned there is a benefit from diversification. So there is a saying that you should not put all of your eggs in a one basket, because if your basket has a problem, then all of your eggs can be broken if those are all in your basket. However, if you just put your eggs into multiple baskets, then maybe if there is some problem in one, still you can secure other eggs, so there will be no problem. So that's the idea of diversification. So usually when we invest in the stock market, we generally try to avoid risk by investing in multiple stocks together. And because of the diversification, now we don't have to worry about unsystematic risk, which arises from a unique characteristic of a company or a stock. Therefore, what we only have to care is the systematic risk, the systematic problem in our economy or the financial markets or the stock markets. So therefore, what we believe is that our return will be proportional to our systematic risk that we are taking. And here we adopt a concept of beta, which is a measure of the systematic risk in a stock. And this measure can have negative values, and it can also have a positive value, and it can be closest to zero, and it can be larger. So the meaning of this beta is that if you have a higher beta, that means when the market fluctuates, when there is a systematic risk, when it becomes the problem, then your portfolio's value will also fluctuate dramatically when you have a higher beta. On the other hand, if you have a low beta stock, that means the value of the stock will be stabilized and it will be maintained as a constant, so it does not change much even if the stock market changes a lot. So if you have a higher beta, it means you have a more systematic risk, and if you have a low beta, it means you have a low level of systematic risk. And the central point is 1. So the beta of 1 means when your market return changes 1%, your stock return changes exactly 1%. So there is a 1-to-1 match. This is the meaning of the beta with the value of 1. So this is the idea. However, now I feel that maybe it would be better to show you how it works. So let me use some information from the US market. So I'm going to find the beta of the Apple. And according to Yahoo Finance, if we visit statistics, it says the beta is 1.25. And what it means is that when the US stock market has a change in its returns, for example, if the return from the stock market increases 1%, then the return of the Apple stock will increase 1.25%. So it means Apple has a relatively high systematic risk, because when the stock market's return decreases 1%, then Apple's return will decrease 1.25%. So Apple is highly affected by the US stock market situation. And let me show you how to calculate the beta from the data. So actually we can download the historical data of the Apple. So because here, according to Yahoo Finance, they say this beta is calculated based on the 5-year monthly stock returns. So I'm going to replicate it, and I can assure you that we will get similar results. So I move to the historical data part, and I'm going to set my time period as 5 years. So from November 23 to 2017 to November 20 today, and I like to have a monthly stock returns, stock prices, and I click apply button. And if I wait for a short period of time, I click once again, and I get the data starting from today, going back to 2017 December. Okay, and if you click download, then you can actually get this data into the Excel, but I already done that for you. So there are several columns in the downloaded Excel file. However, I choose the Apple's adjusted closing price. And also, what I want to do is to compare the Apple's stock returns with the US stock market return. So I googled, and then I found that Yahoo Finance uses the US stock market return as S&P 500. So the S&P 500 is an index which is created by the Standard and Poor's, which is a evaluating company for the financial markets. And they make this index by looking at top 500 companies in the US market, and they aggregate and they make a portfolio composing of those 500 companies, and they try to calculate their stock returns from the 500 companies. So this basically shows the trend in the US stock market, because those 500 companies represent the US economy. And I can also get the historical data. One slight issue is that actually we can download this because there is a copyright issue, so S&P does not allow direct downloading process here. But actually, we can get the data just by dragging this table. So if we do something like this, and if I Control C and I move to Excel and I Control V, I can get the data from the Yahoo Finance. Anyway, I have also made this into this column. So I have S&P 500 adjusted close price here. Let me explain about the adjusted closing price, the meaning of the adjusted close price soon, but let me just continue to calculate the beta right now. So to get the return is so the monthly return can be calculated following this formula. So I calculate the difference between this month's stock price and the last month's stock price divided by the last month's stock price. And then I do this in the Excel. So I have 2018 January stock price here, and I have 2017 December stock price here. So I take the difference and then I divide with this previous month's stock price to calculate the Apple's stock return. And I repeat this by moving this here like this, and then I can get the Apple returns from 2018 to 2022. Similarly, I also calculate the S&P 500 return based on the data that I get. So I have D4 minus D3 divided by D3. Okay, and so if you have done this, you will realize that actually we cannot use the first observation here, because when we want to calculate the return, we need the previous month's stock price. So actually, if we had this number of observations in the stock prices, we have that minus one number of observations in the return. So we cannot calculate the December 2017's returns because we don't have information about the November 2017. Anyway, the beta is the relationship between the Apple's return and the S&P 500 returns. And here S&P 500 represents the US stock market. And there are several methodologies, so I'm going to introduce them. First, you can draw a graph where you set x-axis as the S&P 500 and set y-axis as the Apple. So what I'm going to do is to put a chart like this, and I click that, and then I have to change the data, so I'm going to remove all of them, and then I add one series, and here the x value should be S&P 500 and y value should be the Apple's return for the same period. And then I confirm it. Then I can get this kind of graph. So here, as you can see, the x-axis is the S&P 500 return and y is Apple's return. And you can imagine that there is a trend in this relationship. So as you can see, there is not much observations here or here, but we have many observations here and here, which means when S&P 500 returns increases, generally Apple's return is also high. On the other hand, when S&P 500 has a negative return, Apple's return is also likely to be negative. So that's why we have this kind of trend, although it is not shown explicitly. So there is a way to get the trend line here. So if you click the addition of chart composition, there is a trend line with a linear line, and you will get this kind of trend. And we can also get the equation for this. So we click the option that we represent the equation into the chart, and then it shows the trend line equation, which is y equals 1.2363 x plus 0.0164. And here the coefficient, the number which is multiplied to x, is the beta of the Apple. So 1.236, this is very similar to the Yahoo's calculation that the beta is 1.25. So that's how they obtained it. But there is a small error between two values because we rely on a slightly different set of data. However, the basic idea is the same, so we can find ourselves that we can calculate the beta as 1.23 approximately. And another way to calculate the beta is to use a formula, formal definition of the beta. So the beta is mathematically defined as the covariance divided by the variance. Beta is covariance over variance of this. So let me explain the meaning of this formula. So first, we have a variance here, which is a measure of risk. So this RM is the stock market return. So it means the risk in the stock market. On the contrary, on the numerator, we have the covariance. And the covariance means when there are two variables, when there are two vectors, the covariance shows how much they move together. So if this changes, that also changes. And when they have a similar pattern, covariance is high, while this one changes that way and that one changes on that way, and we have a negative covariance. So when you have a larger covariance, it means they are moving together. So therefore, this is the stock return of your stock. So basically, the covariance, this term means whether your stock's return moves together with the stock market. So therefore, what this formula means is that in aggregate, whenever the stock market changes, when there is a variance or when there is a risk, how much your stock return changes along with the stock market. So that is the definition of this beta term, and that's why it represents the systematic risk, because the systematic risk means when stock market fluctuates, whether or not your stock changes or not. So we are going to use this formula. So in Excel, you can use several functions, and among them we have covariance. And if you type covariance into the cell here, we actually get two types of functions, covariance.p and covariance.s. Here, .p means this is for population, and .s means this is for sample. So the difference between population and the sample is whether it represents all of your data or whether it is just a small subset of your total data. So for example, if I want to calculate the covariance or the variance of your midterm exam score or your final exam score, I have to say that this is the population because you are all students that I have for this class. In that sense, this is a population. But on the other hand, if I just, among those 46 students here, if I choose those 10 students and then I calculate the variance from those 10 students, then this is the sample because I do not use others' information into the calculation. So similarly, if I think about the Apple's data here and the stock market returns, the stock market returns and the Apple's returns are there, starting from maybe 30 years ago, and it will be there also in the future. So therefore, what I'm selecting here is just a small subset of the data, which is only 5 years. Therefore, I can guarantee that my data is sample. Therefore, it is better to use .s here. So I'm going to type covariance.s, and then I need those two columns. So I'm going to put Apple's return and also the stock market returns. And then I close the parenthesis. So this is the numerator, and the denominator is the variance. Therefore, I'm going to type VAR, which means the variance. And then again, I have two different functions, variance.p and variance.s. So obviously, I need to use the variance of sample. So I have variance.var.s. And I need the stock market returns again. And then I close parenthesis. And if I type enter, I get in percentage 123.63. But in number, this is 1.2363, which is exactly the same as this coefficient here, the slope of your trend line. So basically, here we get the same result, because actually what Excel do when you want to get a trend line is to calculate this inside your computer, and they represent it as a trend line. So basically you are getting the same result whether you try to get the trend line or whether you type this function into that. And there is another way to get the same result, and this is called the regression. Regression is a statistical methodology when you want to find a relationship between two variables. So you have y and you have x, and when you want to get the relationship between these two, then you can regress y on x. So basically, we are going to get the relationship as this kind of equation from the data. And that is what the regression does. And Excel can do this, but it is hidden function. So you have to go to the option. And basically, when you start, it is not, for example, there is a term analysis tools, and at the beginning it will be hidden below. However, you need to move this into the active function, and if you do that, then you will find another function which was not there before, which is the data analysis. And if you click that, you can get several tools, and among them you need regression. Sorry about Korean, because this computer is based on the Windows Korean version. So if you click the regression analysis, and they require you to put two series, y term and x term. So y term is the Apple, so I'm going to put this. And the x term is the S&P 500 return. And I don't want to get the results in somewhere else, so I'm going to have this. Oh, sorry. Y is Apple's return. Okay, and then I confirm, and then I get several tables here. So sorry about the language. There is a determination coefficient. It will be written in English. It will be called determination coefficient, and this is number of observations. So at this level, you need only two information here: the determination coefficient and the number of observations. So the number of observation is 59 because we have 5-year data, and for each year we have 12 months. So 12 times 5 give you 60 observations. However, this is not 60 but 59 because on the first month of your data series, you cannot get the return. Therefore, you have returns of 59 months, not the 60 months. And at the same time, the determination coefficient is 0.51, which means your x variable explains 51% of your y variable. So you try to what you want to do here is to explain y with x, and this is very successful because actually among 100% of y, you can explain 50% of the changes by the change in x. So therefore, this means that the regression is very successful. And also, what you need to know is the coefficient here on the last table. So it says the y value is 0.0164 something, and the x coefficient is 1.2362. And actually they are these numbers a and b here. So it means a is 1.2362 something something, and b is 0.0164. And actually that result is the same as the trend line equation. So as you can see, the trend line says the slope is 1.2364, and again here in this regression, a is 1.2362. And similarly, the constant term is 0.0164, and this is the same for the regression. So basically, in all three methods, we are getting the same results. So obviously, this technique is not needed in your final exam. However, the reason that I'm introducing this is because if you are going to invest in the stock market in reality, then maybe you want to analyze the stock characteristics, and maybe you want to know what the beta means. And in that case, here what I'm explaining is the meaning of the beta, so it will help you to analyze the stock markets in the future. So anyway, now we know that beta is a slope in the trend line, and also this is the measure of your systematic risk. And then we are going to think about stock market. So as I told you, now the beta is the systematic risk. And if you remind, we were thinking about the risk-return trade-off. So on the y-axis, we have a return from an investment, and in the x-axis, we have risk. And we found that there is a linear relationship. So whenever your risk increases, you demand more return. So that's the trade-off in the risk and return. So if your return is higher, that means you are taking a lot of risk. And at the same time, on the contrary, if you need to take more risk, then you will demand more return from your investment. So that's the basic principle. And from the diversification, now we know that the risk can be decomposed into unsystematic risk and the systematic risk. And furthermore, we learned that unsystematic risk can be gone forever, so it can be avoided if you well diversify your portfolios. Therefore, we don't have to care about the total risk. However, what we only need to care is the systematic risk in your portfolio. So in the stock market, we say there is a risk and return trade-off similarly to other kinds of investments, but we can just focus on the systematic risk. So we believe there is a linear relationship between systematic risk and the return. And we are going to call it as a reward to risk. And here, the systematic risk can be represented as the beta, and this is the return, R. So I'm going to think about the slope here. And one thing you have to notice is that actually, when there is a zero risk, when there is no risk at all, still you would demand at least a minimal level of return from your investment. So this is called as risk-free return. So this risk-free return means even if there is no risk at all, then you would demand some positive benefit for your future cash flow. So basically, this exists because of the time value of money. So let me think about a bank deposit. So if you put, for example, $100 into your bank account, there is no risk at all. You will be safe, and even though the bank goes to a bankruptcy situation, then the government will guarantee you. So in any case, there's no way that you lose those $100. So there is no risk in your bank investment. However, still you have a positive interest rate from the bank account. That is because you are not going to consume $100 today, but you are going to invest in for the future. Therefore, you are thinking about the time value of the money. Therefore, you demand the minimal return from your bank deposit, and that's why we have a positive interest in the deposit accounts. So that is why we start from this level, not the zero return. And then the slope here can be calculated as this. So on the numerator, we have a return from our investment, and we take the difference of the risk-free return, this. So we start from this, and we move. When we calculate the beta here, how much beta we are taking, in other words, how much systematic risk we are taking, and we calculate the slope. So this is on the numerator, we have a change in y, and we have a change in x on the denominator. And this ratio is called as the reward to risk ratio, because on the numerator, you have a reward, which is the return, excessive return over the risk-free return. How much you demand more because you are taking risk. And on the denominator, you have beta, which is how much risk you are taking. So based on the risk you are taking, I demand this excessive return. So that's the meaning of reward to risk. And for every stock, you can put the reward to risk into the graph, and this will be the result. So for example, there are two stocks. There is a company A and there is a company B. And for the company B, the reward to risk is 6.67. It means for the beta increase of 1, you get additionally 6.67 return from your investment. And for asset A, for the company A, the reward to risk, the slope is 7.5, which means for the increase of beta with 1 unit, you will demand 7.5% return additionally. So you are going to demand more in case of company A compared to company B. That's how these two slopes shows. However, unfortunately, now you'd like to think about which is better investment. So you have to compare the profits from company A and the profits from company B, and you would soon realize it is better to choose company A than B, because for the same level of risk you are taking, it is always better to choose company A because it gives you more return. So on the x-axis we have the risk we have to take, and on the y-axis we have the return from our return from our investment. And if we are taking this level of beta, this means we are taking that amount of systematic risk, and for that level, company B will only give you that level of return. However, for the same level of risk, the company A will give you more return. So it is always better to choose company A than B. So there is no reason for you to choose company B. Therefore, this determines the preference of investors in the stock market. And what happens in equilibrium long time later is that actually those slopes will change. So now we realize that every investor will like company A instead of company B. Therefore, for the company A, what happens here is because you are going to think about the demand and supply. Everyone likes to buy company A's stock. Therefore, there will be more demand, and the price of company A stock will increase. Okay? And then, because the return is calculated as so this is the return of your stock, and here today's stock price increase. Therefore, the denominator becomes larger and this minus term becomes larger, which means your return from that investment will decrease. Therefore, the stock A's return will decrease. And if you go back to this slope, the numerator was the return. Therefore, if the return of A decreases, then the slope will decrease. So it will become flat. And at the same time, company B will not be purchased by any investors. So nobody likes company B's stock. That means there is no demand, but there are a lot of supplies in the stock market. Therefore, because everyone hates it, the stock price of B will decrease. And then today's stock price decreases and today's stock price decreases. Therefore, stock B's return will become larger. And therefore, this slope will become rigid, so it will go upward and upward. So the slope will become higher and higher. So finally, the company A's slope will be flat and company B's slope will become rigid, so it will eventually meet on the same line. So that finalized version of the reward to risk is called as a security market line. So because every stock will be competitive, they are competing in the stock market for the choice of the investors, they will have eventually the same reward to risk, and therefore there is only one reward to risk slope, and that's called as a security market line. So this graph, the next graph shows the finalized return reward to risk in the stock market. So now A and B are on the same line. They are not having different slopes, but they have the similar slope. The difference is that the level of risk they are taking, they require is different. However, they are on the same line, which means for every unit of risk you are taking, you will earn the same amount of return. And if you understand this, we can get the conclusion. So we were talking about the portfolios, and all portfolios, as same as individual stocks, will have the single security market line. Therefore, the reward to risk for any two different portfolios will become the same. The reward to risk is RF divided by the beta of A So on the left side, we have a portfolio A's security market line, and on the right side, we have portfolio B's security market line, and they should be the same. And now I'm going to set the portfolio A as an individual stock, such as Apple, and then I'm going to set portfolio B as the overall stock market, which have every stock in a single portfolio. And then it becomes this formula. So therefore, any individual stocks reward to risk should be the same as the overall stock market reward to risk. And here, we already know what the beta of market is. It is 1, because beta is the change in your portfolio value when the stock market changes 1%. And because the overall stock market will obviously change 1% whenever your stock market changes 1%, there is a 1-to-1, so beta M, it should be the 1, because that is the benchmark. And therefore, this will be gone. And you can multiply beta I on the left side and the right side together, and then you get this formula. And here, you are going to move this RF, risk-free rate, onto the right side, and then you get this formula. And the notation, if we change the notation to following our textbook, this is the textbook version of the CAPM. So the expected return, in other words, expected returns of the shareholders or the investors, is the cost of equity. And here the risk-free, this is RF, so the risk-free return is the government bond return. And the beta is the same, and the excessive risk, market's excessive risk over the risk-free return is the risk premium. So we get the following, the final CAPM formula. So that's why we had this, and using this, now we can calculate the cost of equity for any company, and then we are going to use this cost of equity into the weighted average cost of capital, so that we will use that WACC or WACC as the discount rate whenever you want to evaluate an investment project.